Risk management looks different for everybody. The first thing is only trade with money that you can afford to lose. Number two, avoid taking too much risk on one trade. If your account is small, you need to play tight at first. You need to understand options risk. It's very unforgiving. If you do the wrong thing with options, it can really hurt financially. I recommend trade common shares before you jump into options. You got to learn the mechanics of trading. So understanding when to exit, when to enter, when to take profit, when to take a loss, all those things are very unforgiving when it comes to options. So I recommend you start with common shares. And again, it comes down to risk tolerance. Some people will be okay with doing options when they're first starting to trade because they have a different level of risk tolerance. If you have a lower risk tolerance, you want to be trading common shares before you touch options. Number three, you will be wrong. So managing the loss is number one. I will discuss more on that. Now, when you take a trade, you have to know exactly how much you might lose if you're wrong. If I do X and this does Z, what will I do? You always have to have that in mind. So you got to know if you're wrong, are you going to take a quick loss or are you going to let the loss grow larger and larger if you're wrong? So you have to know what you're risking at all times. Number five, risk management may vary based on your style. So whether you're a day trader or a swing trader, the way that you take losses, the way that you think about losses, the way that you think about trading, much can be different. If you're day trading, you want to be in and out of positions fast, 5 minutes, 2 minutes, 15 minutes, depending on what's going on with the market, right? If you're swing trading, then you're holding positions overnight for multiple days, for a week or 2 weeks, depending on what your strategy is. So you have to understand what the risk management looks like for each of those strategies before you start taking those trades. Now, you have to tailor your management based on your personality. So everyone's personality is different. Everyone's financial circumstances are different. There is no one set rule that I or anybody else can tell you because everyone's different. Maybe, losing $500 to one person may be a really big deal and the other, it might not affect them at all, right? So if you're someone that is not affected by potential loss because you understand that this will take time, this will take losses, this will take experience, you need to understand that you have to trade smaller, you have to be more patient, and you have to understand that you're not going to make a lot of money right away when you're trading, especially with a small account. So let's jump into some examples on account size and a simple guideline. Let's say that you wanted to put a maximum loss of 2% per trade that you take. If you're in a swing trade and you're down 2%, then you take the loss. You don't look back. So if you have a $2,000 account and you employ a 2% per trade strategy, then your risk is $40 per trade. You don't want to lose more than that. Why? Because if you're wrong a couple times, that's okay. It's not going to destroy your account. So here's some basic examples based on account size with a 2% per trade guideline. Now, you want to have a rough idea of what this means for you. You don't have to use 2%. It could be higher, it could be lower. It really depends on you, right? This is just a simple example. So if you have a $2,000 account, your maximum risk is $40 per trade if you're doing a 2% max risk. So what that means is if you're in a trade and you go red by $40, you have to take the loss. You can't sit there and wait to see if it goes back up. You have to take the loss because it allows you to be wrong several times and not blow up your account. Let's say you have a $5,000 account, then that can afford you a $100 loss per trade. If you have $25,000 and it's $500 per trade. So you could see how it escalates quickly depending on your account size. You might have a bigger account size than $25,000. So you can do the math. You can lower the max risk. It really depends on you. There is no one answer. And when emotions get involved, that's when you start to break these rules. Now, the other thing is you must have a stop trading rule, which means if you lose X amount in 1 week, you have to stop trading for that week. You want to stay on top of the market and be aware of what's going on, take notes, but you do not trade. This comes down to, again, your risk management, right? If you have a set risk management and you say, hey, if I lose, 2 trades, then I stop trading for the week. This enforces discipline because it becomes very easy to not follow those rules because of emotion, because of wanting to make money. This is a very real thing. Greed, fear, all these things affect risk management, and everyone's psychology is different. So there is no one answer for anybody. All right, so this slide is one of the most important slides of this video. This shows you the amount of gains that you need to make if you lose a certain percentage. If you lose 5% of your account, then you need to make 5.3% on that money to get back to break even. So it's not terrible. If you lose 10%, you need 11.1% to come back to your original starting investment. 15% is 17.6%. Now, this is where it starts to accelerate. If you lose 20% of your account value, now you need to make 25%. At 25%, it goes to 33.3. 30% goes to 42.9. 35% goes to 53.8. Once you get to a 40% loss, now you need to make a 66.7% gain to get back to your original investment. If you lose half of your value of your account, let's say you start with $1,000 and you lose 50%. Now you have $500. You need to make 100% gain to get back to your original $1,000. Now, this continues on, and if you lose 60%, now you need 150%, and so on and so forth. You can look at those numbers there. It gets maximized over here at 80%. Now you need to make 400% of your account. So this is the most important slide that this entire video has. If you understand this, you will be much more careful with your account based on your personality, based on the numbers here. You have to understand what it is that you're doing with your money. The whole goal is to keep the chips so you can play the game. If you lose all your chips on one trade or, a few trades, then it's going to be psychologically damaging for you because a loss is going to take a very personal form. This shouldn't be personal at all when you are trading with money that is not essential to you at the moment, right? Again, this looks different for everybody. I hope this helped. If you have any questions, let me know.